Welcome back to the Options Academy. In our earlier presentation about time spreads, we mentioned that the phrase calendar spreads could be used to describe many strategies in which two options of the same nature, two calls or two puts, are sold and bought in two different months. When two options are sold and bought with different strike prices and with different time horizons, the structure that is created is known as the vertical calendar spread. We think this is so impressive. The vertical calendar spread will leave you horizontal. Here is a comparison between a time spread and a vertical calendar spread. If you sell a January 1000 call and buy a February 1000 call, you have a time spread. If you sell a January 1000 call and buy a February 1030 call, you are looking at a vertical spread. In this comparison, we can see that in the time spread, the two options that are sold and bought are identical in their strike prices, while the options in the vertical calendar spread consist of two different strike prices. Let's look at the debit and credit profile of the vertical calendar. Unlike the time spread, which is always initiated at a debit, the vertical calendar spread may be initiated at break-even, no cost and no credit, or at a credit. This flexibility comes from the ability to choose how wide a spread you wish to create between the short option you sell and the long option you buy. For instance, if you sell a January 1100 call and buy a February 1110 call, your debit will be greater than if you sell the January 1100 call and buy the February 1125 call. And the debit will be even greater than a spread in which you would sell the January 1100 call and buy the February 1150 call. The reason for this is that the farther away from the money in option trades, the cheaper it is. Therefore, while in all three examples the January 1100 call remains and fetches the same premium, the cost of the long call becomes lower and lower as you buy farther away from the money, bringing the total cost of the vertical calendar spread down. To illustrate, you can refer to our written article and take a look at three examples. As you will clearly see, the value of the February calls declines as you buy farther away from the market, while the January premium remains constant. Therefore, the wider the vertical calendar spread is, the less it costs, until eventually the transaction may actually result in credit rather than debit. Let's look at the risk profile of the vertical calendar. As you know by now, there is always a give and take, and each action brings with it advantages and disadvantages. It's like getting a colonoscopy. The advantages is you're enduring in good health. The disadvantage is you're getting a colonoscopy. Here, the benefit of widening the spread is manifested in a smaller debit or an actual credit. The weakness is manifested in the form of a wider spread and therefore greater potential risk. As long as the underlying market trends away from the options, the short call and the long call, the additional risk does not come into play. In fact, in the examples above, should the underlying market trend down, the risk profile for the vertical calendar spread is lower. When options are far out of the money, a long-term option could gain similar or even more value than a short-term option. However, when they are trading in the money, a short-term option would gain more value than a longer-term option. Therefore, when trading the vertical calendar, it is important to remember that the risk on the trade increases if the market approaches the spread. This results in having to walk a very fine line. The fact that the vertical calendar spread is most risky when the market's traders near the short option creates somewhat of a challenge in practical trading. The issue is that while the risk is high at that level, so is the profit potential. In fact, the profit potential of the vertical calendar spread reaches its peak if, at expiration, the market settles just below the short option you sold. When this happens, the short option you sold expires worthless and the long option you own gains value as the underlying market draws closer and closer to its level. We recommend that when using the vertical calendar spread, you create a strict set of guidelines. These guidelines should match your trading philosophy, your risk tolerance, the funds in your account, and so on. Once you've set your guidelines on the trade, we recommend that you follow them as faithfully as fans used to follow the Grateful Dead. Though we recommend staying away from the tie-dye t-shirts and funny cigarettes. Let's see some vertical spread scenarios. On October 1st, 2009, the Standard & Poor's 500 closed just above the 1027 level. Let's create a breakdown vertical spread. That is a vertical spread in which no premium was collected and no premium was paid. On the same day, the November 1100 call and in December, the 1125 call both settled for exactly the same price, 14.9 points. For the ease of writing in simpler math, we will round up the number to 15 points. So again, we presume that on October 1st, 2009, we entered the following trade. Sold one November 1100 call and collected 15 points. Bought one December 1125 call and paid 15 points. We therefore entered the trade at break even, excluding any fees you might pay. We are going to enter our time machine and travel 50 days forward to the exact day in which the November options expired worthless. Let's take a look at these three scenarios. Let's look at the flat market scenario. In real life, 50 days later on Friday, November 20th, the S&P 500 closed at the 1090 level, 63 points higher than the point of inception. Prior to that point, the market briefly visited 1112 level on November 16th and drew back, allowing the November option to expire worthless. Using the option chain to calculate the approximate value of the options in a flat market scenario, we want to look at the value of a December option, which is trading 88 points away from the market level on November 20th. The difference between the December option and the market level at inception was 88 points. This would simulate the approximate value of 1125 options if the market stayed flat. Since the market expired at the 1090 level, we will examine the December 1180 call. On November 20th, the December 1180 call option settled for 1.4 points or $350. 1.4 times $250 equals $350. Since the trade was initiated at break-even and we can now sell the December call for approximately $350, this will be our profit on the trade, again, excluding any fees. Not really anything to rave about, but nonetheless, it is written in black rather than red. So even if you can't rave, you can secretly gloat a bit. A completely flat market, therefore, not a likely scenario, but of course a possible one, would yield a very small positive balance. Let's look at a bearish market scenario. Since a flat market scenario showed us a pretty much flat result, we can safely assume, even before examining a bearish move, that the trade will yield neither profit nor loss, excluding fees. Nonetheless, let's take a look and be sure this is clear. In order to estimate a bearish move of, say, 50 points, we will simply look at December options that are trading 138 points above the level of the market close on November 20th. 88 points was the original distance of the December call from the money, plus 50 points farther away since the market moved down. We will look at the 1230 December call. This would simulate the value of the December 1125 call if the market would have moved 50 points down. On November 20th, the 1230 December call settled for 20 cents. Since the trade was initiated at break-even, here too we are looking at a virtually break-even scenario, again excluding any fees. Now let's look at a bullish market. Since the market actually moved up 63 points, roughly 6% during the period of the trade, we need not move or rearrange the options in order to examine the results. We simply have to look at the December 1125 call option and see its value in order to calculate our profit. On November 20th, the December 1125 call option settled for 10.7 points or $2,675. 10.7 times $250 equals $2,675. Again, since the trade was initiated at break-even with no cost to you, and because the November option expired worthless, if you sell your December 1125 call, you would receive $2,675 as profit on your trade. Before fees, nothing to sneeze at. While this bullish move brought about some handsome profits, and believe us when we say there's no such thing as ugly profits, we would like to look at two more bullish scenarios with you. These will help you gain a better understanding of the risk profile of the vertical calendar spread. Considering a scenario in which, on November 20th, the S&P 500 settles at 1125, such an event would put our short position completely in the money while leaving our long position at the level of the market, thus turning it into an at-the-money option. To examine the result of such a scenario, we'll rearrange the options on the options chain. In order to do that, we simply have to look at a December option that traded at the money on November 20th. We already know that the November 1100 call was worth on that day. It expired 25 points in the money, and therefore its value at expiration was 25 points, or $6,250. 25 times $250 equals $6,250. Since we are looking for an at-the-money option, and since the market closed at 1090 level, let's look at the December 1090 call and check its value. The 1090 December call settled for 26.8 points, or $6,700. 26.8 times $250 is $6,700. If the December option settled for 26.8 points and the November option expired for 25 points, the news is good. You are ahead of the game with a profit, excluding fees, for 1.8 points or $450. 1.8 times $250 equals $450. It is worth noting at this point that if your spread has been wider, for example, 40 or 50 points between the short November and the long December, you would have had a loss on your hands. Simple. If the long now at the money option has a value of 26.8 and the short option expired with a value of 40 points or 50 points, you would have had a loss of 13.2 or 23.2 points respectively. Therefore, the wider your spread is, the more attentive you need to be when the market moves against your position. Let's go back to our 25-point spread, short November 1100 and long December 1125, and look at your yet one more scenario in which the market zoomed up unimpeded and closed at 1175 level. Following the same methodology we used before, we will look at a December call option, which is 50 points in the money. If the market would have closed at 1175, our long December 1125 call would have been 50 points in the money. We will compare its value to the November call, which we know expired with an intrinsic value of 75 points. Going once more to our option chain from November 20th, we look at the 1040 December call. 1090 minus 50 equals 1040, and discover that it has settled for 63.3 points. Here is where you see a more significant loss potential developing, when the market made a strong bullish move that breached and surpassed both your options. In this case, the loss is 11.7. S&P points. 75 minus 63.3 equals 11.7, which translates to a loss of $2,925. 11.7 times $250 equals $2,925. As always, excluding fees. There are virtually endless scenarios we can study and numerous situations we can illustrate and compare, but we think the examples we used are a good place to start and provide plenty of information to digest. We hope these examples help shed some light on the concepts we reviewed earlier in the presentation. The two most important issues we want you to take away from this presentation are vertical calendar spreads may be these. While the greatest potential for profits in a basic vertical calendar spread takes place near expiration and near the short-term option you sold, so does the greatest potential risk. Bear in mind, as you see your trade reaching that point, we hope you have enjoyed this presentation. We encourage you to call or email us with your questions or remarks. Here's to your success. And remember, there is substantial risk in trading futures options. Remember that past performance is not necessarily indicative of future results. And remember that only risk capital should be used. We hope to see you soon.